Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Chris Englebert. He's the founding partner and Chief Investment Officer of Englebert Financial Advisors, and we are going to discuss how communication is so important right now between clients and their advisors, and both need to be accountable for it. Chris, great to have you back with us on Trade Talks.
Oh, great to see you again, Jill. The last time we did this was in February, so how times have changed.
They certainly have, and who would have thought at the beginning of the year with the economy and the market firing on all cylinders that we would be doing this virtually, which really does attest to technology and being able to pivot. And I'm sure as an advisor, your life has had to change instantly as well. I can't even imagine what it has to be like communicating with your clients and holding hands and managing portfolios when the market just was free falling. So I want to discuss that with you, how important it is to communicate. And part of it is clients need to be open with their advisors.
Yeah, you're right, Jill. So you're one of the things that really stands the test of time is obviously how people react to times like we've had. And this has been something, I've been doing this for 37 years. I never in my wildest dreams thought that I would then, eventually be video chatting with clients or talking with them. But one of the things that it was been very interesting the last couple of months because, when the markets declined and the markets recovered, we were really reaching out to clients, and we had clients say, "Oh, I think you're really busy. I didn't want to bother you." And we would say to these clients, "No, you don't understand. I need to know what's going on with you and what your situation is." So they really need to talk to us. I just had a conversation the other day with a client that, they've been doing very well. They're still employed. Income is okay. But she made the comment, she's like, well, there is a possibility I may be furloughed in 30, 60, 90 days. I don't know. And those are really the important conversations we need to have, because if that's the case, do we continue to, hold more cash? Do we, not have as much cash? So now more than ever, the clients really need to reach out and not be embarrassed. Sometimes people are embarrassed. Hey, I lost my job. I got furloughed. What am I going to do? And this has been unbelievable times. We had another client talk to us and say, hey, I lost my job, but he's already got several offers in the works. So the communication, the clients really need to talk with us about what's happening with their lives.
And as an advisor, how do you handle those conversations when you have a client come to you that you might have had for years that is towards the end of their career, looking to retire? They just lost their job. What's it like as an advisor having these difficult conversations?
Yeah, you got to have candid conversations. We know a lot about their situation already, but one of the things you have to talk about, and we actually do this ahead of time. We talk about leverage all the time, how much time, how much debt people have. And, if you're considering retiring in 2 or 3 or 4 years, are you really going to buy a big house, or are you looking to downsize? So it has to be a candid conversation. Hey, you've got this much money. Here's how much money you have for retirement. What kind of game plan should we be talking about? You can't, and this is something where I tell a lot of it, when I talk to other advisors, you got to be real careful on the message you give your clients. You can't be too negative and you can't be too positive. You got to be literally middle of the road, down the line, candid, very authentic and real with them about what's happening.
As an advisor, what are you doing to proactively reach out to your clients?
It's interesting because we have had to pivot. As you know, we're big on social media, and that's been one of our saving graces. We've been using a tool for the last 2.5 years called BombBomb. And so, for example, I have my trusty whiteboard up here. And so on Tuesday, we literally did the video. We can do a personal video to all of our 401k participants. And we did a video talking about the retirement plans, how they've recovered, how it's a much more positive scenario. So we were already on that wagon of using personal videos to reach out to people. And it's funny because we stepped up how many personal videos we were using the last couple of months, where we were doing them once every 3 or 4 weeks. At one time, we were doing them once a week. And I got a lot of positive responses from people going, thank God I heard from you. Hey, I really appreciate you. It was really gratifying to hear that. The other thing that we did is we've been doing a lot more Twitter Live and Facebook Live. We really ramped up our Facebook exposure. Every Wednesday, I do a Facebook Live around 11:30, 12 o'clock. We do a Twitter Live. Again, people are at home. They're looking for something to watch, something to do. and all of a sudden it pops up that you're going to be live. And, I give little market updates. A couple of weeks ago, I talked about life risk. So it's allowing us to really push more content out there, which again, if you remember a couple of months ago, you and I talked about this. We think a lot of advisors are making a mistake by being much too passive, that they really need to get out there and communicate with their clients. And that means much more than just shooting them an email.
Yeah, well, that's the one silver lining that we have learned from the pandemic is just how much more connected we are to our clients, our coworkers, our families. And I believe that whether we all go back to work or work from home 100% or in a hybrid role, things certainly have changed. And I think for the good when you talk about connectivity and being able to show your clients that you can pivot. But let's take a look at our first chart today with our monthly market review. We'll take a look at the S&P 500. And Chris, I mean, since the pandemic has started, it's like we went from all-time highs to a recession to a depression, all the way back to all-time highs. This is all in a span of less than 100 days.
Yeah. And so one of the things that we were very disciplined about is that our risk indicators were elevated the first part of the year. We raised cash for clients. We were playing defense, never in my wildest dreams. I mean, we had the fastest decline online. What I feel really good about is that we didn't freeze at the switch. And so we reallocated people's money. It was very difficult to do the end of March, very difficult conversations to have. But we actually have clients that are positive for the year. And the S&P 500 has just accelerated upward. And interestingly enough, I've actually been doing videos on why the stock market's doing so well. We did a series of videos that it's a discounting mechanism for what's happening in the future. But the other thing that we're really trying to have people understand, Jill, is that when you pump $2 trillion of liquidity into the economy, it's got to go someplace. And we think the two places it's going to go is housing and the stock market. And so that's why the S&P is accelerating like it is.
All right, let's take a look at our next chart here, the Nasdaq 100, which has actually led the way back with the recovery, considering the amount of technology and work from home stocks that are within the index.
Yeah, I was on a call, and you had a very good call. I think it was last week with the cloud computing stocks and what's going on there. Mm-hmm. I hope our viewers scroll back and look at it because that gentleman did a very good job.
He did do a great job.
Explaining what was going on. And in fact, my daughter works for one of those types of companies, and she's been telling me stories how companies have had to pivot not in months but in weeks to get computers out, get everybody online. So obviously the Nasdaq's been the biggest beneficiary of that, and you go to new all-time highs today on the Nasdaq. And again, people can't quite figure out what's going on, but what's happening is that these companies are really beginning to accelerate that are in the cloud computing space. Now, having said that, today's obviously a very strong day. We've noticed the last couple of days, maybe weeks, that value is starting to come back. And you and I last summer saw this happen where large cap growth, slowed down for about a week, 2 weeks maybe, and everybody's like, that's it, large cap growth is done, it's value play. And all of a sudden, the end of the year, growth took off again. Now, after this recent decline, growth has led the way back up. But I've noticed the last week or so some pivoting and beginning to see value. The bank stocks have done extremely well the last week. So the real question is for the end of the year, is this finally the move from growth to value?
Yeah, it almost feels like the value trade is almost a trade versus the longer term investment mentality when you're looking at stocks that are going to take us through the next few decades with work from home, with these hybrid roles, with cloud computing. So it's going to be interesting to see certainly how that plays out. And if we take a look at our next chart here, the Russell 2000, which encompasses some of those value names, certainly was the laggard and even still playing a little bit of catch up.
Yeah, no question about it. I mean, and again, we've seen literally in the last week, tremendous strength in the small mid-cap stocks, obviously from the Russell. And this also could be the fact that, the economy is opening up and companies are getting back. And, one of the videos I did previously is I was saying, if you have two companies, one's in the S&P 500 and one's smaller, and God forbid a meteor comes out of the sky and drops on one company and wipes it out, which is essentially what happened to a lot of smaller companies, that the bigger companies could pivot quicker, they could get computers out, they could get things going. Well, the smaller companies were losing business and sitting on the sidelines. I think what the Russell 2000 is showing now is that those companies are getting off the sidelines and are getting back in the game.
All right, if we take a look at crude oil next year, certainly it's going to make a move with demand coming back on, but still there is a supply glut out there. and demand isn't even close to where it was just a year ago.
Yeah, I mean, we missed this call. I mean, we had a call. I mean, it was only a couple of months ago that crude was in the 70s, and it was really looking like there was going to be some type of acceleration, and then we basically fell off the earth. Again, we've seen. It's funny because the charts of crude are almost paralleling the charts of the S&P 500 exactly. If I had to make a call right now, I would have to say that you could see crude trade sideways for the foreseeable future because there's going to be this huge demand, glut supply playoff, and how it plays out between now and the end of the year. I'm neutral right now on the oil markets. I mean, we had negative oil, prices here a couple of weeks ago, and we've rebounded sharply, but there's still a lot of supply out there floating around in the ocean.
All right, and let's wrap it up with the 10-year Treasury.
Yeah, I think this again is one of the biggest surprises out there. I mean, we had a cataclysmic decline in yields. They bottomed out literally in the last 3 days. I mean, yields have started to pop up, but for about 6 weeks, yields were in a very narrow range. Now, this also participates in one of our theses on why we think the housing market is going to do so well, is because you've got super low mortgage rates, and people are going to be going out there and saying, okay, now I can buy $50,000 or $75,000 more of a house, and this low interest rate scenario is going to lead to it. So, I mean, rates are extremely low. I mean, they could literally pop back up at any time, to over 1%. But for right now, it seems that we're going to be in this lower interest rate environment for the foreseeable future.
All right, Chris, great to have you back with us. Thanks so much for joining.
Very welcome. Great to see you again, too.
And thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.